Okay, so it's now it's now noon. We're slated to start, so welcome everybody to this call. What we'd like to do is to update you with latest liquidity data for end of October 2020. The picture is as you see in front of you in terms of the context of global liquidity, our global liquidity index going all the way back to the mid-1960s. Liquidity has basically just come through this pronounced V-shaped formation. The latest index data is actually more or less unchanged on September, so it's elevated at index levels of around 90. As you can see, historically, it doesn't really get much better than this. There is huge amounts of liquidity in the system, and that is likely to propel economies faster next year and to at least sustain in the near term asset markets. The amount of liquidity that is thrown into the system is kind of eye-watering. Central banks have pumped in around 6 trillion this year, which is about a 1/3 increase in their balance sheets. And global liquidity in total, in dollar terms, is likely to end the year at about $155 trillion, which is something like a 12-13% increase. Sorry, about a 15-16% increase, I should say, on 2019. Looking into 2021, it seems fairly likely that that liquidity boost will continue. So we expect central banks to be able to put in another 4 to 5 trillion. The assumption that they're going to be monetizing around 50% of government deficits, and government deficits will remain large next year too. And that will likely have a similar effect in terms of global liquidity, pushing it up by another 12 to 15%. To somewhere near 175 trillion, which puts it at around about twice world GDP. So if you look at this diagram, basically what it's showing is really the track of global liquidity as a percent of world GDP right back from the mid-1990s, when it was around 100% of world GDP. It's now touching 200%. So the fact is, you've seen this phenomenal increase in liquidity in the world economy. And what we'd like to do is to trace out the consequences of that, first in general terms, and then we'll get down to the specifics of individual markets. If you look at total liquidity versus debt, I think that's a very important axis to think about, because liquidity and debt have both jointly outpaced world GDP. What you have going on is effectively a debt liquidity spiral. And with every turn of that spiral, credit risk tends to increase, which is actually commanding or forcing central banks or policymakers to keep coming in to fix the system. In other words, it's a spinning and quite fragile axis, but while debt increases, liquidity is needed, and as liquidity expands, debt is needed. And this is a very important axis in the sense that liquidity is increasingly collateral based, and high quality debt is important to growing liquidity. And debt needs liquidity simply because once you issue debt, it's not just a one-off operation, you've got to refinance it. Debt needs to be rolled over, and so there's a continual need for balance sheet. And one of the things that policymakers have been very late in the game to understanding is this requirement or joint requirement between liquidity and debt. So you've got this spiral which is unfolding, and that is necessitating more and more policy action. So as far as we can see, this whole game of QE is a long-term game. Central banks are going to find it extremely difficult or impossible really to step away from that now. What are the consequences? Well, the consequences are both near-term and longer-term. And in the near term, I want to look at the latest data we've got, which is showing on the left-hand slide global liquidity in the short term, really from 2015 onwards, and the pronounced increase that we've had, not just since the COVID crisis, I hesitate to say, but actually also through 2019, and particularly when the repo crisis first appeared around the summer of 2019. And that was the first flag to central banks that the system was in trouble and needed more liquidity. And it comes back to this whole need of rolling debt over and balance sheet. The financial system needs balance sheet, and therefore you need liquidity. Liquidity is balance sheet. Where we are now, as that chart is indicating, is elevated levels of global liquidity. But if you look on the right-hand chart, the way that we judge that liquidity is against what we call world investors' risk appetite. Now, we have this data country by country, which I'm going to go through in a second, but risk appetite is a measure of how investors are positioning themselves in financial markets. Now, the way to think about this data, and there's lots of white papers we've written about this feature, is that the zero line is measuring a neutral asset allocation between equities and safe assets like cash and government debt, or particularly G10 government debt. If you move down on the scale to -20, you are running an asset allocation, or the world investor, average world investor is an average asset allocation, one standard deviation below normal in risk exposure. At -40, you are 2 standard deviations below, and at -60, 3 standard deviations below. Similar on the upside, +40 is 2 standard deviations above, +20 is 1 standard deviation above. Where we are right now is at still comparatively low levels. This is the data as of end of October. There's been a rally, as we know, in markets since then on the vaccine hopes and the Biden election, and markets are now, toying with that zero line, but they certainly haven't overtaken it yet. But this is really saying that, number one, chart on the left, lots of liquidity. Number two, that liquidity is not yet being deployed. It's affecting markets, but it certainly hasn't pushed them up to sky-high levels. We would be concerned about risk assets once that red line on the right-hand chart starts to get into the 20 to 40 zone. 40 is a time when we would begin to reduce exposure, but not yet. Let me give some further color on the background for liquidity in terms of both the geography and the type of liquidity, just to emphasize that the world economy is kind of firing on all cylinders here. The left-hand chart is looking at the breakdown of liquidity by economy. The pale blue line is the US. The US has led this rally. As we said earlier, it's to do with the initial response to the repo crisis in early 2019, but it's carried through. You've seen other pronounced effects. The black line is the UK. There's been a phenomenal increase in UK liquidity since the COVID crisis. That has been matched by the Eurozone. You're seeing clear evidence of emerging markets now picking up, and Japan has also come, albeit late into the party, in terms of adding liquidity too. But the three leaders in this are the Eurozone, the US, and the UK, which are at the top of their typical ranges. Also, if you look at by type of liquidity, so we think of liquidity also by source, general source, policy liquidity is what the central banks do. That's clearly elevated, as you can see on the red line on the right. Private sector liquidity, which is the cash flow generation of the private sector. It includes corporations, households, it includes banks, shadow banks, all sources of cash coming from the private sector. That's elevated as well. That's, if you like, courtesy of the fiscal programs which have helped corporations and households generate cash. And then you see cross-border capital flows, which is the gray line, which I think is important to stress, because this is typically, certainly for emerging markets, a key input into drivers of asset gains. And that has remained robust through this crisis. There was a lot of talk at the beginning of the year about how investors were pulling out huge amounts from emerging markets, etc. The data doesn't really show that, in fact. There's actually been a lot of resilience. This is not like 2008, when there was a very clear exodus of international capital from markets. It's actually stayed there, and the fact that international capital is increasing is showing there's growing confidence among investors. Now, let me just look at one particular example of that, which is the US. And I want to take the US as an example, really because of the extreme drop in risk exposure in the US in April, March, April of this year. It was unprecedented, but the scale is just eye-watering as to what happened. And I know I've spoken about this before in previous calls, but it really is worth thinking about. What you've got on this diagram is our risk appetite index for the US. It's drawn daily. We can now get this data for 20 countries on a daily basis. And this basically shows asset positioning in risk assets versus safe assets, with 0 being the average, the 5-year average, and again 2040 as 1 and 2 standard deviations respectively. Now, the data is taken up to, I believe, the 9th of November, so it's very up-to-date data. The drop below 40 on that index, the pronounced drop below 40, occurred in March, mid-March of this year. The US index, risk appetite index, went heading down to levels just not seen before. If you look at the long-term track, as we'll show you later in this presentation, we've never got down to these levels before. In fact, the dotted line on the graph shows where risk positioning of US investors went to at the time of the 2008 GFC, which was an index level of about -52. What we ended up with at the low point in early April was a risk appetite reading on our scales of about -90. I mean, it's absolutely never been seen before. It is a remote possibility. And in fact, the color is, as told by one of our clients in the US, and I think I've repeated this before, is that Fidelity said that as of middle of April, 20% of all their account holders in the US had sold every equity they owned. Such was the panic. Now, the rebound in markets that you've seen occurring through late spring, early summer has taken us back to slightly below neutral weightings, and the rally that we've had in days has basically taken that index to about +6. So it's still around neutral, and it's not yet at levels where you'd expect to see a problem, which is up at +40. So in our view, although there may well be better opportunities in other markets, the US still seems to be very well underpinned by liquidity conditions. Now, just to bring home this point, here is a ranking, which I hope you can see, or certainly we'll send the slides out afterwards, but this is a ranking of all markets worldwide by risk appetite, or risk positioning, if you like, as of the 9th of November and as of the end of March 2020. The data on the right-hand slide in red is the end of March 2020. And what you will notice is that most markets were in that depressed area of being negative, which is showing that their risk exposure was skewed towards safe assets like government bonds and cash, and well away from equities. There were very, very few markets where investors had above average positions in equities. One of those was an anomalous one, which is all frontier markets, but that's probably structural because weightings are going up, trending up significantly higher. But then you've also got markets like Denmark, Netherlands, Switzerland, which are very defensive markets anyway. And so those were elevated. Right at the bottom of that red stack is the US. That's never happened before. And it shows to what extreme levels US investors panicked at the time of the COVID crisis in March, April. Where we are now is illustrated on the left in orange. You can see that some of those defensive markets remain high on that chart, but there's been quite a lot of movement in the 6 months or so since the bar chart on the right. And what I've done is to highlight the world in sort of dark red, as you can see about midway down. But then at the bottom, there are a collection of markets that just are at extreme cautious readings. In other words, investors are positioned heavily in safe assets. And those are Italy, South Africa, the UK, and Canada. Australia is a tad above that, as you can see, as is then, it goes Thailand, Hungary, Portugal, Mexico, as these other markets. Singapore is still quite low, etc., on that ranking. At the top are, collection of markets. Hong Kong's up there, Taiwan, Turkey has rebounded, Korea has rebounded, China's moved up a lot. The US is a tad above normal, as you can see, but given the rally that Wall Street's seen, I mean, even that's surprising that it's only just got to those levels. So what this is really saying is that there's a huge amount of opportunity within equity markets to make money over the next 12 months, and to look into those laggards are really worth doing. We've got a lot of empirical work to show that if you buy into equity markets when you're down at around the -40 area on that index, your 2-year ahead returns average about 35%. So that's a pretty good heads up to making money. Whereas if you invest at the top of the ranking at around +40, you tend to lose about 15% over the coming 2 years. Now, let me keep going on this theme about economic recovery, and I wanted to single out the UK as well, because the UK is right at the bottom of the list, and that is just, I think, very ill-deserved. The media is wholeheartedly negative here about almost everything, life in general almost, and that's clearly causing distress among a lot of investors or downbeat views. First, as an intro, on the left-hand graph, you've got evidence from the US on the economic rebound. We show liquidity as that orange line, and the blue line in this case is the average of the Philadelphia Fed and New York Fed Empire State surveys looking at future prospects. And what I've done is to increase our liquidity, or move forward our liquidity index by around 12 months. Now, what you can see is not a perfect correlation, but actually eyeballing it, a pretty remarkable and close correlation between those two series. Given the fact that liquidity is leading, you would expect further economic gains over the coming 6 months, at least in the US. If you look at the UK, I've just to demonstrate we're not cheating in this, I've actually gone all the way back to the late 1970s, where data begins, and I've looked at our liquidity for the UK, which is the orange line, and the black is the UK CBI, Confederation of British Industry, orders data, shown it's rather like the US ISM, but that's actually reported in black. Now, what that shows is a remarkable correlation. The liquidity data is leading by 12 months. What is the need for economic forecasters, we question, when this is such a good lead indicator? And what it should be saying is that there'll be a significant rebound in UK economic activity over the coming 12 months. And that would suggest that unless history is broken, and this data no longer applies, and we are in a completely different world, buying UK equities is actually a pretty decent trade looking forward. But generally, if we move to this next slide, what it's showing here is that it's not just UK equities, but generally asset markets are buoyed by more liquidity. And what you can see on this graph is our growth rate of global liquidity, shown as a growth rate, not an index here. We've projected the 173.4 trillion of global liquidity we expect for next year on the graph, which is shown as the growth rate on the dotted line. So growth comes down from a peak at the end of this year, but it still remains elevated at levels of around 12 to 15% for next year. The black line is the value of all wealth worldwide. It is basically a database that includes something like 250 trillion of financial assets, plus precious metals, plus the housing stock, the residential housing stock worldwide, which we took from the BIS database, the BIS Bank for International Settlements database on housing data, and that's been included. And what you see is a very close correlation between the two series. The gap between the orange and the black suggests there is a catch-up in asset markets to come. The rise that we've had in world financial markets in the last 10 days has probably taken us up to around about 8% on that chart. So it's moving up closer to the orange line, but there's still further to go. So I still think there will be gains to be had. Now, if we keep going on this whole theme, let's just reassure ourselves that there's absolutely no bubbles in equity markets. This is the first way to look at that, or initial way to look at that, which is a straightforward ratio between all equity holdings and the total value of liquid assets or liquidity, global liquidity in the world economy. And that ratio averages around 0.5 over the long term. In fact, if you do a statistical analysis on the data, you can see that it's very clearly mean reverting, and it mean reverts back to that level of about 0.5. And that's been the case certainly for 3 decades. The peaks are obvious. One was at Y2K in 2000, when the index peaked at around about 0.85, 0.86. There was another peak just ahead of the global financial crisis in 2008 at about 0.7. We are currently at 0.5. The prospective reading as of end of 2021, looking at the liquidity pool that we expect, is going to be something like about 0.43, 0.44 or thereabouts, which would take us right towards the lower end of the recent range. Now, liquidity may not be everything, and people will say, well, okay, what about fixed income? And here is a equivalent chart, which basically looks at equity holdings versus the total pool of safe assets, as we calculated, which is developed market fixed income. So the value of issuance of G10 fixed income, let's say, plus all world central bank balance sheets together as an aggregate in dollar terms, divided into the stock of all holdings of equities worldwide. That ratio comes out currently at about 0.78. The long-term average has been about 0.75 on that chart, and the prospective figure to the end of 2021, taking into account the increases in liquidity we expect from central banks and the raft of new issuance that is anticipated from treasury departments worldwide, would take us down to something like 0.68 or thereabouts by the end of 2021. So no evidence of bubbles, a remarkably stable series with clear mean reversion, and we are well below bubble levels. And the whole point here is that in terms of understanding asset allocation from a global top-down standpoint, we do not look at things like PE ratios. They work wonderfully at the stock level, but they do not work at the market level. Other factors are important, and the reason is that asset allocation is cultural as well. In other words, if you're in an economy such as Japan, you need to match future liabilities of pension schemes or investment or other liabilities that the people, households have, and therefore you need an asset mix that will actually match that duration and that size of liability. And therefore that liability stream dictates the assets that you need. And that is, as I said, much a cultural thing. It depends on risk appetite in the country. It depends on the tax structure. It depends on the demographics. It depends on expected inflation. Hence, you find that in Asian economies, there is typically very high cash and bond weightings, small equity exposure, whereas in the West, and particularly in the UK or America, you more typically have a 60-40 equity bond split. So those cultural differences are very important when you're coming to understanding asset allocation. And the whole point at the moment is, with QE going on, taking out government debt, with lots of cash being injected through that same mechanism, there is a shortage of duration for investors to actually match their future liabilities. And equities are a long duration instrument, which is vital in this type of climate. Finally, on this score, let's look at the ratio of non-US equity holdings to global liquidity ex the US as a further way of saying, well, actually, Wall Street may be sort of pushing limits or higher limits, but the rest of the world is really cheap. And if you look at this, this is the outlook for world equities on this same ratio, ex-US, ex-Wall Street. And you can see there that actually by the end of 2021, if our calculations are correct, you're coming down to one of the lowest levels of that ratio over the period that we've seen. Again, absolutely no evidence of bubbles. Equities look very well positioned. Let me just move towards the dollar because that's another key issue, I think, for people to think about. And it's certainly something that will color the risk-taking environment looking forward. The way that we look at currencies in general and the dollar specifically is to look at the mix of liquidity. And the mix of liquidity is shown on the left-hand graph for the US, which is basically the differential between private sector cash generation and Federal Reserve liquidity injections. Now, typically, when private sector cash flow generation exceeds the Federal Reserve actions, when the yellow line is above the red line, that leads to a stronger dollar. When the red line is above the yellow line, the dollar tends to weaken. Now, the rationale for that is that Federal Reserve liquidity is pure supply. The yellow line of private sector liquidity is an indication of the profitability or cash generation of the US private sector. And that's really a heads up for more investment in US assets. So that's a proxy for the demand for dollars. So when the yellow is above the red, there is excess demand for dollars. And when the red is above the yellow, there is excess supply of dollars. And we plot that differential as the red line on the right-hand chart. And you will see it there being advanced by 12 months as a leading indicator and graphed on top of the trade-weighted dollar. Now, the trade-weighted dollar is shown here as percentage deviations from its trend. It is not a year-on-year change because that would be cheating in terms of this relationship. It's a contemporaneous displacement to show that actually the Forex risk index is a very good predictor of currencies going forward. Now, we can get a little bit more color on what's going on in the dollar region by looking at this chart, which I know I've shown a couple of times before, but I think it's illustrative of why the dollar may be going down gradually. This is not a collapse in the dollar, make no mistake. It's the dollar is going down gradually. And, and what you can see here is the backdrop of capital flow into different regions. Now, what we've identified here are three different regions, Europe, Asia, and the Americas, and you can broadly take those as indicative of currencies. So you can think of Europe as the euro, Asia as some hybrid between the yuan in China and the Japanese yen, and America's the dollar. What you've had for the US or the dollar area are three major periods of capital inflow. The first of those was in the mid-1980s when Japanese insurance companies were very large buyers of the US Treasury market. The second was in the wake of the Asian financial crisis in 1997-98 when flight capital moved into the US. And you can see that those spikes in the US data in the black line are mirrored by falls in the orange line for Asian, indicating Asian outflows. And the recent period from around 2014-15 onwards, where you've seen this huge spike in dollar inflows. Now, that has been the result of two factors. One of those, as you can see probably immediately, is the collapse in the orange line, which was capital leaving Asia. And this was really two things. First, it was the effect of Xi Jinping's anti-corruption drive in China, which drove a lot of flight capital into dollar assets. And the second was the decision to squeeze the shadow banks in China and stop them accessing offshore lending or offshore borrowing lines, which meant that dollar borrowing lines were closed, and hence that was a flow back into the dollar. On top of that, the blue line is indicating capital outflows or inflows into the euro area. And following the Eurozone banking crisis in 2010-2012, there was a net outflow of capital, which you can see by that negative blue line. All this data is as a percent of global liquidity. What we've seen recently is that capital is moving back into the euro area or to Europe. Capital flows to Asia have stabilized. So there's a small outflow, which is largely Japanese bond buying in the US and Chinese FDI into the Belt and Road economies. But otherwise, it's remarkably stable. And what you're seeing is a progressive slide in US capital inflows, still positive, but coming down. And so the impetus behind the dollar is dropping. Now, I just want to add one point here, which is to clarify what is, I think, a general confusion. People talk in the same breath about the dollar rising or falling and the dollar being used as the main standard of value in the world economy. The two things are very different. You can have a very widely used standard of value that can still weaken in price. And that's the situation which is ideal for the US. If the US wants to create a dominant currency, it's already fairly dominant, but to actually knock out competition from, let's say, the euro or from the yuan, what it needs to do is to get the dollar, A, more widely used, and B, hopefully, or in theory, lower in value. And as the dollar starts to drift lower, more people will use the dollar because it's a more competitive currency to borrow in. And you've got to remember that more and more funding is done through the dollar. So if the dollar is gradually weakening in price, you'll get far more borrowers coming in. That will increase the ability of the US to control the system. And you can see one of the things that has evolved in the last decade, or actually, to be correct, in the last 5 years even, is the progressive demise of the euro-dollar markets as a funding source and the increasing use of US official swap lines directly through to foreign central banks as a funding source. So the whole nature of the world economy is changing, but all I'd say here is that the dollar is becoming a dominant currency. It'll be challenged in different instances, but it's becoming more important. But that does not mean to say that it's going to be stronger. It will likely be, we think, weaker, certainly in the near term. One of the other consequences that I want to think about the liquidity background is inflation. And we've pointed a couple of times before to the risk of inflation picking up in 2021. And I just want to articulate that a little bit better from what we've observed before. And the way to think about inflation, in our view, is to distinguish between the two main drivers of inflation, or the two main drivers of high street inflation, to be more accurate, which is monetary factors and cost factors. So cost inflation and monetary inflation. Now, monetary inflation comes from central banks devaluing their currencies against generally against real assets. So you might think of gold as a very good benchmark for real assets. So one way to think about monetary inflation is the rise in the gold price, or more generally the rise in asset market prices. And that's an instance of monetary inflation. That is what central banks in theory should be controlling against. That's what they have in their gift, to control or stabilize the value of money. And that's really what the remit of central banking should really be about. The orange line is what the private sector does. And the private sector can create inflation or it can create deflation. And one of the things that we've pointed out before is that if you go back to the late 1960s, 1970s, what you had then was a combination of monetary inflation in the wake of the collapse of Bretton Woods, when effectively policymakers worldwide were able to print money with some alacrity, and simultaneously a cost inflation that was coming through because of the rise of big government and less productive spending, and also because of the hikes in oil prices around the early to mid 1970s, combined with unionization, heavy unionization, and big wage claims. And so what you can see on the graph is that sort of unusual period or picture of monetary inflation combining with cost inflation. And what that period was characterized by was high street inflation. And each element was about 50% of the total. What you've seen since is monetary control, beginning in the US under Volcker, where monetary inflation basically became zero, and cost inflation came down progressively over that period. Now, what really pushed cost inflation a lot lower in the 2000 decade was three things, but the most paramount of the three was the introduction of China into the World Trade Organization in 2001. And that caused massive deflation, cost deflation in the world economy. The other factors were technology improvements and demographics. But China, I think, is the big effect. Now, what you had by the end of the 2000s, I should say, was actually cost deflation. Central banks panicked at that stage and thought, oh my God, we're seeing this normal deflation and we've got to slash interest rates. But we weren't seeing, we were seeing overall deflation, but it wasn't monetary deflation. And that's what they should be guarding against. So the slashing interest rates was a real error. And that's what created this debt boom that we've been talking about and the fragility of the financial system. What they should have done through that period was actually to hike interest rates, maybe to expand liquidity, but to hike interest rates under what people generally call the Bagehot rule after the British monetary economist in the 19th century. In other words, lend freely, but at a high interest rate against good collateral. What you've got now is a situation where cost inflation is beginning to pick up. The 2020 has clearly been depressed by the COVID crisis, but what you're seeing is rising evidence of cost inflation coming through. You're combining that with a monetary inflation. What central banks should be thinking about already is raising interest rates, but they're not. They're gonna let interest rates remain low. They're gonna keep the monetary drug pumping, and basically what we face is a combination of some monetary inflation and cost inflation, which I think will take US CPI to levels of 3 to 4% next year. That is not great news for bond markets. It's not bad in the near term for equities, because a lot of people will move towards equities given the fact that they are an asset which is largely hedged in real terms. The problem for bonds is illustrated here. And what we show is the US 10-year Treasury yield in orange, and the blue line is a factor model that tries to predict the US bond market using three very simple factors. One is the US ISM index, the Purchasing Managers Index. Two is the Australian dollar, US dollar cross rate. And three is the price of copper, which is all those are indicative of cyclical moves in economies. And what you can see from all three factors, they are lifting the blue line higher and indicating that US Treasury yield should be around 2%, not 0.85 or whatever they are now. They're moving up, but they're not moving up that rapidly. And that gap is an anomalous gap, which will be closed over the next 12 months, we would think. If you get bond yields up to 2%, that is saying that bond prices are going to be down by around about 7 to 10% in the US over that period. That will focus attention. And that is not even bringing into account the inflation risk that I've just highlighted. So let me finish with a summary of the equity market outlook. And what I'm going to end with is two sets of 4 charts. These are the risk appetite charts that I spoke about earlier on, but these are the time series which basically show the risk positioning of investors in different markets. And it's just to bring home where the opportunities lie and the fact that we're just nowhere near bubble territory. The US is shown here. The highlight that we went through earlier is that it was dropped down to the sort of minus 90-ish reading in March of this year. It's since rebounded. Latest reading is +6 as of November 9th. But we certainly are not at the levels where you'd normally be selling, which is up at the +40. Japan, lower left, is equally or looks equally attractive. It's probably at similar levels, maybe a tad below where the US currently sits. But you know, buying Japanese equities at these levels is not bad. Look where Japan was just prior to its bubble bursting in 1989, early 1990. Again, over the 40 point, Japanese market came down very heavily in 1996 when there was deflation. But if you look at the picture, the risk appetite was very high then. Japan's been a great buy when it's been in the lower half of its diagram. Eurozone top right, that's showing risk appetite at unextended levels. It's picked up, one would have to say, in the last few days, particularly in markets like France, which is now above 0, but generally the Eurozone is still in that low territory, and markets like Germany look rather more attractive than some of the others. UK is just off the scale. I mean, this is just ridiculous levels of risk exposure in the UK. Investors are just not looking forward sufficiently optimistically. They're saddled by the coronavirus lockdown again, and by fears over Brexit, and by the fact the media are just churning out black news the whole time. But this has got to be a great opportunity in what is that 4 decades of data. There's only been one previous opportunity to get into UK equities at similar valuation levels or exposure levels, which was immediately after the 2008 global financial crisis. Had you done that, you'd have made a lot of money, but that's been the only other occasion. Emerging markets, one would have to say, don't look quite as attractive as the developed, but they're not bad. I mean, markets like Brazil are still depressed. That's not a bad opportunity looking longer term. China's already had quite a move, but it's still not at levels that it risk positioning that it was at before in the late 90s, early 2000s. India has bounced up a bit, but actually, to be frank, I mean, you're buying in the Indian market at levels which are well below average levels, certainly over the last 10 years. It looks attractive. Russia is really just an energy play, so it's a little bit difficult to make a sensible comment. So that's where we are. We're still optimistic. We think that liquidity is driving economies and markets forwards. Markets never go up in straight lines, we know, so there's bound to be some pullback after what's happened in the last few days, but generally the environment looks good. Risk appetite is still at low levels. It can expand. Liquidity is going to remain elevated thanks to central banks, and you've got the dollar, which potentially is weakening gradually, and maybe deliberately, and that's got to be a good background for risk-taking worldwide, which it normally is. And I think you're going to see further gains over the next 12 months. So let me stop to see if anyone has any questions. I think everyone's on mute, so there may even be a chat if there is a there's a chat people can use if you want, or unmute yourselves if that's possible. Or maybe we have no questions. Here we are. Sorry, there's a question coming through. Question from Mark about sterling and the euro. Okay, let me just address the sterling thing. I think the issue is that, to come back to the dollar and maybe use that as a starting point, the dollar will, we think, go down, but what is it likely to go down against? And I think that's obviously the key question. Gold is likely to be a beneficiary of any dollar weakness. I think that's can be taken as read. What about the Asian currencies? One of the things that we've noted in previous discussions is that the Asian currencies are mysteriously stable, both against themselves and against the US dollar, in a way that I've never seen before. And if you just look at a chart, and I would put a chart up, I've got one, but I haven't got one in this deck. So maybe I'll include it when we send these charts out. But if you look at the the notional Asian currency unit, it's just trading sideways against the US dollar, and it's basically trading within the Asian bloc very stably against each cross rate. So there's no great deviations. And it seems as if there's a managed currency environment going on there. Now, if that's the case, if the dollar weakens, Asian currencies will move with the dollar, and therefore they will neither appreciate nor devalue. and therefore there's more pressure coming on the euro. So I think the problem is that the euro is likely to go up. And you can think about this idea of the euro and the Asian currency units, maybe through the eyes of Germany and China. These are the two major export countries in the regions, and they would like to shelter behind other countries to stop their own individual units going up. And so that's what they benefited from historically. Now, the problem that the euro area has is I think it's very difficult for them to actually keep the euro down in an environment where capital is moving into Europe, maybe on recovery hopes for the region. And basically, what you've got is now an increase in bond issuance coming from the European area, which will likely entice a lot of foreign money, which will further put upward pressure on the euro. Now, what can they do? They can use open mouth operations, as they call them, to try and talk the euro down, which they do every time it gets near 120. But they don't really have the monetary instruments. Can they go into more negative territory? I don't think so. There's always going to be a constraint on how much they can expand their balance sheets. And the reluctance is by the Germans to do more because of the just whopping size of these target 2 imbalances, which really is a constraint. And fiscal policy, we know, is kind of difficult anyway. So the difficulty there is keeping the euro down. So I think the euro is potentially the stronger currency. Now, when it comes to sterling, sterling, I've always thought, trades pretty much equally between the dollar and the euro as a rough average. So therefore, I would suspect that the UK pound will not go up as much as the euro, but it will appreciate against the dollar. So it's kind of a midway point, if that answers. So I think that, you know, I would suspect that you would see sterling, well, let me do it in terms of euro first. I think there's a risk of the euro going up to about 130, 135 next year. And I think there is a chance that sterling would go against the dollar to maybe similar figures, but that would still mean that the that sterling is not appreciating you know, that much against the euro a bit. Let me get another question about cost push inflation. If there's cost push inflation, okay, will the long end of the Treasury hit 3 to 4%? And is that bad for risk assets? Well, I think the answer to that is that I think there's a risk in the US Treasury market of yields going up. I think what's holding back the yield base is going to be two things. One is that I think there'll be a commitment, certainly in the short term. Let me put maybe if I can put the yield chart up. There's a risk that yields will go up, but the Federal Reserve will maintain interest rates at zero-ish or at low levels, a commitment to that, I think, in the short term. And they've said that that's what they'll do. The issue is that they're almost deliberately behind the curve here. So the fact that they're anchoring interest rates at policy rates at near zero for the next 2 years is going to have some impact on pulling down or stopping yields going up too much. So they'll create a much steeper curve. But I don't think you'll get yields at the 3 to 4% level. So real interest rates will be negative. I think you'll get 10-year yields above 2. I think that's a risk. I'm not so sure about 3 to 4. In terms of the other factor that will be holding yields down, I think there is also the general fact that despite the prospective heavy issuance of bonds that we're going to see, there is still a shortage of duration in the system. And that's an awful lot of makeup to do by policymakers or treasury funding over the next 2 or 3 years to make good the difference. Really, because we've come through this austerity policy of the last decade with there being very little bond issuance or high quality bond issuance. And, you know, that's occurred simultaneously with Basel III commitments for banks to actually increase their exposure to safe assets, and similarly for insurance companies. So there's been huge excess demand for these things. So it's not going to dissipate quickly or easily, but I still think that the direction of travel is for higher yields. I think inflation is a serious bogey next year. And I wouldn't want to be a lot in the bond markets. Is that bad for risk assets, which is the sort of final sort of question I think to raise on this? I think ultimately the answer must be yes. It will be bad for risk assets. But I think that what we've seen through the experience of the past, and 86, 87 are very good examples of that, is that it takes some time for the equity markets to adjust to rising bond yields. In the short term, they take the euphoria of economic recovery and maybe rising pricing power positively. And what you see is that investors tend to shift out of bonds into equities. So I think you've got to think about this in two stages. Stage one is if you get short-lived moderate inflation, which is what I think will be the case, you'll get a big asset shift from bonds into equities. If you get sustained inflation at high levels, you'll get a shift out of financial assets generally into real assets. And that's what happened in the 70s. But what happened in the 80s, the mid 80s, is you just saw the first stage of that, is that assets went in from fixed income to equities from late 1986, if I recall, and they basically flowed into equities through 87. Now, what we may take as a benchmark, and this is perhaps a timeline to think of, is that there may well be a bubble inflated that causes an equity market crash in October 2021. Now that wouldn't be fanciful, and that would be a very similar timeline. But I still think in the near term, we can make equity gains. And I think you're going to see this rotation both out of Wall Street and out of fixed income in the window before then. Hopefully that answers the question. I don't know if there are any more questions lined up, but happy to answer any in the next couple of minutes if there are. Let me give it a couple of ticks to see if people come in, or unmute, or whatever you'd like.
Michael, can you hear me?
Yeah. Hi, Mark.
Hi there. So I get the point that there's incipient inflation that's coursing through the system and it's on the horizon. But you've got massive issuance of treasuries, right, because of the pandemic. And then within the next 5 to 7 years, you have a lot of these unfunded liabilities that we've all conveniently forgotten about.
Yeah.
I'm not looking for a drama queen scenario, but I'm just wondering, given how low rates are and given the onslaught of potential issuance, is there a problem that could manifest itself when trying to refinance all this paper, or it is what it is and the world is comfortable at these rate levels?
Well, I think this is the key dilemma. I think that what we're saying is, in the near term, there is so much liquidity around that markets look good, but as you start to extend the horizon, you start to see serious problems, and the serious problems are basically coming down to, I would say, two principal factors. One is aging populations, and if you're a demographer, the key number I think is 2022, when you start to see a net shift of world populations on average into away from net savings into net consumption. So you start to begin to see a tumble in savings ratios, or you should be at that point. Now, what we've had for the last 20 years is abundant savings, which have helped to keep interest rates low and have fueled financial markets. So we're at that cusp where they begin to go down. So I think number one is that the pool of savings worldwide is going to be under pressure. Factor number two is that we're seeing the need for a lot more of those increasingly scarce savings to go back into the real economy to basically fund some of these factors like green energy or infrastructure build, or even to clear up the mess after COVID. So there'll be a lot more demands on that. And then you rightly said there's the third element, which is the funding of of these liabilities, not just the COVID liabilities, but upcoming pension liabilities and entitlement spending in the US in particular, which need to be funded. So there's a problem. And what I think where that problem expresses itself is you've got the sort of the persistent problem of demographics hitting the sort of immovable object of debt, and that's where you get this debt liquidity spiral, effectively, becoming, as you say, a sort of drama queen question, and the whole thing could unravel. Now, central banks so far have papered over the cracks, and they've been very instrumental in pumping in lots of liquidity to basically keep this whole show on the road and to give us the balance sheet necessary to refinance the debt. And effectively, it's kicking the can down the road, but hey, it works so far. The problem comes is when inflation becomes a bogey or a hurdle. And the issue really comes down to, these two factors. One is that if you look at the graph that I've got in front of you, which is the cost inflation factor or the cost deflation, I mean, whether we're right or wrong accurately with his numbers, the general tone that we got is that there is an inflection in in the long-term trend in cost inflation. And that long-term inflection point was probably around 2010, 2012 period, where you saw probably in reality, a little bit of cost deflation. Now, what we're seeing now is a gradual buildup of cost inflation pressures. Now, whether that's to do with regulation, whether it's to do with the demands of green energy, whether it's to do with factors like the decoupling from China, the cost of re-onshoring onto the US, back into the US, I don't know. Whether it's to do with the scarcity of labor in an environment where demographics are aging fast, all these factors come into play. And I would suggest that where we are is in a cost inflation environment that's moving away from zero towards maybe 1 to 2%. Now, that's probably livable with, but 1 or 2% sure isn't zero. And what's more, you've got monetary inflation, which is being created because central banks are pumping all this money. Now, monetary inflation may not be a big issue, but it could still be 1 to 2%. So what you're looking at is prospectively a 3 to 4% trend coming back into high street inflation. Now, that is not, as I say, not a serious problem. It's not the 12% or 15% we were seeing in the 70s, but it clearly focuses the mind of central bankers. Now, central bankers have been independent of governments up to now, in inverted commas, and they've been prepared to keep interest rates at very low levels. And they said they're going to persist. But once you start to see an inflation problem being embedded, I question whether they will have that ability or willingness to do that. And that's where you'll get a clash. And I think that it's not maybe in the next 12 months, but it could be in the next 24 months that you start to see these issues being raised. And I think that the cost will be that rates will simply have to go up. Now, the way that is resolved in the system maybe is that rates go up, but liquidity remains abundant, and that facilitates refinancing. So it comes back to this sort of budget rule of if you're going to lend, lend at higher interest rates, but lend, with lots of cash against good collateral. That may be the way forward. But I think there's a serious problem upcoming, and it really is that you get this flip in cost inflation. Now, that's the thing that central bankers don't distinguish between. They're just looking at all inflation, but they're not saying, is this monetary inflation that we're causing, or is it cost inflation that's coming through from the real economy? They shouldn't really be worried that much about cost inflation, providing that it's gradual. Because in the long run, what we know is that the private sector tends to manage that itself. I don't know if that answers the question, but it's, these are big issues.
No, thank you. I mean, ultimately, the question is, and this is what people, I guess, are arguing about is, will inflation come back? And that's kind of the dichotomy in the marketplace now. But the issue that the central banks will try to anchor rates actually argues that they're going to miss it and they're going to overstay. And that in itself will promote greater inflation. But anyway, time will tell, I guess.
Yeah, I think they're going to miss the monetary inflation. They're deliberately creating a monetary inflation. I don't think necessarily they have a great deal of power by themselves on the cost element. That's just a fact of life, but that's to do with productivity rates, demographics, China effects. If you bring in low wage labor from China, etc. There's not much a central bank can do about that. They can change the monetary bid. They can create monetary deflation. But if they create monetary deflation, how are we going to roll the debt over? We can't do that. So their hands are tied on that regard. So I think their commitment to keeping rates low persists in the near term. But I think they're going to have to seriously question that looking longer term. Or if they don't question it, the bond markets will. They'll just demand higher rates. And if you're cynical, maybe like me, you'll say, well, okay, at the end of the day, central bankers tend to follow the bond markets rather than vice versa.
And do you see, just real quickly, any risk of the dollar losing value quickly? Because in the past you had talked about what happened to sterling after the war, the First World War.
Yeah.
We went through a period where
it
lost.
I think that's an interesting episode, and that's one for the history books. But if you look at how the dollar became important, the dollar became important in the wake of World War One, when the UK needed to preserve precious bank capital, so they forbade British banks from actually lending on trade credit internationally, and America, needless to say, jumped into the gap, and so you saw the dollar taking off from World War One through the early 20s through trade credit, and that was the major vehicle that it used. Now, it wasn't a straight line move. Actually, the dollar was the most important currency in the 20s. It eclipsed sterling temporarily, and then sterling fought back when the dollar devalued against gold in the early 1930s. But that was really the beginning of the dollar push, if you like. So history is important in that regard. If you come back to sort of what's happening right now, I think the question is what is your alternative? In the 1920s, there were alternatives, and those alternatives were gold, they were the US dollar, they were sterling itself, there was the French franc, there were a number of viable alternatives, and those other currencies did get a place. If you look now, I think the choices you've really got are gold, the euro, the dollar, possibly the yuan. Now, the rise of the yuan is definitely on the table. It will occur, but I think you've got to be realistic about how far it can go. And the more that China is contained in the world economy by US policy, the less easy it is for China to develop the yuan system. But they're clearly trying to do that. The reason they developed swap lines, as I've gone through before, is because they are going to embark on a trade credit market in yuan. That's the only logical reason for them to do swap lines. Chinese government swap lines are now the second biggest worldwide. They may have even increased faster than the US in the last 3 or 4 years, but that's really the remit. What they need to do, as I think I've outlined before, is to do 3 things to get the yuan on the table. One is to develop a trade credit market. They're doing it. Number 2 is to open up their bond market to foreign capital. They're doing it. And second and third quarters have seen big inflows into Chinese government bonds. They're in the indexes now. And the third thing is to develop a digital yuan for peer-to-peer transfer. That seems to be there and working, certainly, or it's in trial at the moment. So all those things are there. Now, central banks will want to fight that, and the Fed in particular. And I think hence the alacrity in the last 6 weeks for the Federal Reserve talking about a digital currency move. And that will, I think, inevitably happen. So I think that there'll be moves to try and make the dollar more attractive as a currency to use, but I don't think that necessarily means that the dollar collapses in value. The dollar may weaken in value, but I think there is, there are other things afoot here. The US economy, this is a part of a longer conversation, but if you look at the geopolitics of the US is actually in a really enviable situation in many ways. There are negatives in the US, but the positives are big. And the positives, I think, come down to 3 or 4 things. One is that US demographics are actually a lot better than most other regions. They're not anything like as bad as China or Europe. And they're maybe not as good as India, but they're some way towards that. Secondly, the US has got a technology lead, and it's got great universities, and that clearly is on a par or better than China. If you look at commodity production, the US is there in terms of now being a net exporter of oil products and holds a lot of other key agricultural commodities and surpluses. And there's no other economy that can feed itself and produce technology. And then fourthly, you've got the rise of the new NAFTA, the US MCA deal between Mexico, Canada, and the US, which actually means that US supply lines, given they're going to onshore further, basically are all land-based. You don't need shipping or maritime moves for your supply chain. And actually, the US can move north-south even more and down into Latin America. And so the potential for the US economy is great. Contrast that with China, where China basically still needs to import all its energy and a lot of its food, and it needs to go to the Middle East. It needs shipping lanes open, and the only country that can actually maintain shipping lanes worldwide is not the Chinese Navy, but the US Navy. Chinese Navy will find it very, very difficult to protect any shipping beyond the island chain. So I think that what you've got here is a situation that would suggest that the dollar is still a paramount currency. There are challenges, but that doesn't mean to say that the dollar goes up in value near term.
Thank you.
Good. We've overrun a tad, but if there are any other questions, happy to take them. Otherwise, there's nothing on the chat. Thank you all very much and look forward to another engagement next month. Thanks again. And we'll send the slides out. Thank you.
Thank you.